everyone is okay with that audio level. So I should move the volume too. So hopefully we're going to kick off our inaugural Zoom meeting with no more hitches. We already had one, so I worked through it, so we're good. So with that, try to keep the message on topic and use the chat feature like we've used previously. And other than that, I don't have any other ground rules. So with that, go ahead, Mr. Helms.
All right, thank you everyone for tuning in or coming to the Director's Cut webinar and press conference. So we're talking about September oil and gas numbers and a little bit of history behind those. Occasionally we jump over to an October or a current number. Just, you know, some of the topics lend themselves to that, but we're really talking September here. So pretty captivating numbers. I think that's what I'm calling them. We're back over 1.1 million a day, and it's been a year and a half since we saw production over 1.1 million barrels a day. So the last time was March of 2016. So it's been quite some time, and it's very encouraging. Oil production up almost 2%, 1.6%. Interesting, the gas production is down, and Justin provided me a good statistic there. That hasn't happened since November of 2014, so it's been 3 years since we've seen an oil increase with a gas decrease. And I have to attribute that to rigs. Now, there's a significant number of rigs that are drilling outside the core area of the Basin, so we may continue to see some shift in that area. We'll just have to watch it and see. Those numbers put us 17% above the revenue forecast that was established for the biennium during the legislative session. So very strong production numbers, and that's a real positive if you project them out through the end of the biennium. Another area of real high numbers, October permitting. 147 drilling permits and 2 seismic permits. What we're seeing there is a seasonal effect where industry in October got really serious about drilling permits and making sure they have locations built before severe winter freeze-up sets in. So that's typical. I would not expect that to stay at that level going forward. That should provide them with plenty of permits to get through the hard part of the winter. Oil prices, quite a bit stronger. Where today's price, $48.75 for North Dakota sweet crude. So we're trending up. We had several months of low oil prices. So we still, when you look at the NYMEX price and compare it to revenue forecasts, we're still about 2% low if you project that out through the biennium. So production numbers should more than make up for that, but we still are lagging revenue forecast numbers in terms of oil prices. Good solid rig count numbers, 56, 56, 56, and 55. So they're hanging right in there. We're not seeing a drop in rig count as we head into winter. So that's pretty encouraging. And we're right in that area of oil prices where that should remain pretty constant. OPEC meets the end of this month. And the anticipation is that they will extend the production cuts and the quotas through the middle of next year. So that's what the market is pretty much banking on. You can see it in the NYMEX strip where you see oil prices climbing through June of next year and then dropping after that. And that's kind of an unusual shape to a curve like that. Usually futures prices get higher as you go out into the future, but the market is thinking that OPEC is going to pull the plug on those quotas the middle of next year. So that's really what the market appears to be anticipating. Saw a little bit of a drop in the last few days in oil prices, and that came about because the IEA, the International Energy Agency, dropped their demand growth just a little bit. They dropped it 100,000 barrels a day, which it's interesting. In a world that consumes 97 million barrels of crude oil a day, 100,000 barrel a day drop in demand would really affect oil prices. And so it's kind of like the market is looking for any signal to tell it where to go right now. The U.S. crude inventories continue to trend downward, a little bit slower than they were earlier in the year, but they continue to trend downward. And so still looks like in the first quarter of 18, we ought to be in those average crude inventory numbers. Good news, the number of wells waiting on completion is down, as is the inactive wells. The real struggle is in gas capture. And so what we saw in September is not good news. We had 6 significant, what we call force majeure events. Those are unanticipated maintenance problems, or pipeline being down, or road restrictions making it impossible to move natural gas liquids, things like that. And so what we saw is, for the first time in the 3 years that we've been following that gas capture, we didn't meet the goal. We're 2% above the goal in terms of flaring, or 2% below in terms of capture, however you want to look at it. And we don't think it's something that's going to be repeated. It looks like it was kind of a worst case scenario where there were a lot of right-of-way problems, there were NGL takeaway problems, there were compressor maintenance problems. One of the compressors that went down is still waiting on parts to come. And so we do have a struggle, and you can really notice it in the trust lands on Fort Berthold. And that's where the 2 right-of-way issues are. And those have been a thorn in our side all along. Now, we think that one of the right-of-way issues got resolved in September. So hopefully the October numbers will look better. But the other one still is not even approved, let alone resolved. So it'll be next year before the one on the southern end of the Mandaree district gets taken care of. Not much change on the federal stuff. Just a little bit of movement on some of the litigation, but really nothing much going on there in terms of comments on rule changes and that sort of thing. It was time to present break-even numbers again, and so we redid the break-even numbers, and they're pretty much lower across the board. That's good news for attracting capital to the Bakken. And the only real reason I could find was well productivity's gone up. And so even from second quarter of 17 to third quarter of 17, initial productivity of wells is significantly better. And one place that's a standout, and it was asked about maybe last month, maybe the month before, is what Liberty is doing in northern Mound Trail and southern Burke County. And I took a look at some of those extended lateral wells. Those wells are producing 2.5 to 3 times the initial production rate of the 2-mile laterals that were drilled previously in the area. So that's really pretty encouraging, and that has affected Mound Trail County. Not really enough data yet to redo the Burke County numbers. I think those wells will be coming off confidential, and next time we do break-even numbers, we may see that in the Burke County numbers. But encouraging nonetheless that Bakken continues to maintain its place as number 1 or number 2 in terms of productivity per rig. Still have to compete with the fact that there's a lot of leasehold to be secured in the Permian and in the Anadarko. But once those basins reach a similar level of maturity, you'd expect companies to bring their money back here where they make more money for every dollar invested. So with that, I'll take some questions.
Reporter's very happy that you mentioned well productivity, because they were wondering how long are horizontal wells being drilled, and is there a push to drill longer laterals?
Yeah, we've seen a trend lately, particularly in some of the non-core areas. I think in the core area, we're still seeing the standard be 2-mile laterals, but several companies have been moving out to the edges or outside that core area, and they're drilling 2.5 and 3 mile laterals. So we've respaced a few different areas from 1280s to 1920s, and to fit all that together. And it's very encouraging. Not to mention that the new drilling rigs seem to be capable of incredibly fast drill times, even in those laterals. And I think I mentioned it to someone last week. I was at the Slauson pad on the Van Hook Peninsula week before last, and they had just finished drilling 2.5 mile laterals. One took 3 days and one took 4 days from drilling out of the 7-inch casing to reaching TD on a 2.5 mile lateral. So the drilling rigs and the frac techniques using slick water and the larger sand loads seem to be making 2.5 and 3 mile laterals work very well.
That slides right into the next question, if y'all don't mind. Is the larger amounts of sand, is that one reason why we're seeing an increase in production? We
think so. I know Justin has done some analysis, and maybe we can share those curves with folks. You probably don't have it with you today, but the one where you show the 2011 through 2017 year over year well productivity, you can easily see that the typical well, or the average well, compared to a 6-year-old well is producing something like 70,000 barrels more in the 7th month of its life than a well in 2011. So much better. What appears to be happening along with better productivity is less difficulty with frac hits and well interference. And so what we think is happening with the big slick water fracs and the heavy sand loads is they're getting a much more complex fracture network around the wellbore, and not reaching out as far and connecting with the offset wells. So the technology really seems to be making a lot of money for the industry.
Okay, same question line, if you guys are okay with continuing. Can you give a volume in terms of sand and water that are going into these longer laterals?
Yes, the average volume of water for year-to-date 2017 is almost 8 million gallons, and sand is between 11 and 12 million pounds of sand. So those numbers are up probably 1.5 million gallons and 2 million pounds of sand more than what was being pumped a year ago.
Any estimate on how much the longer Burke County Montreal laterals are affecting overall production?
Well, there's only 3 of them on production at this point, but all 3 of those wells are 800 to 1,000 barrel a day wells. So when you're looking at a month-over-month production increase of almost 20,000 barrels, that's represents a 1/6 of that, a 1/7 of that. So it's significant, and I think once Slauson is able to complete some of these long laterals in Van Hook, it looks like that one pad all by itself could potentially produce 20,000 barrels a day. So.
Okay, well, we'll let the webinar quit hogging the show if anyone in the.
Well, it's about the natural gas. So do you expect it to come back into goal in October?
Yeah, so the question was, do we expect to be back meeting our gas capture goals in October? And the short answer would be yes. But we are going to, I think, struggle month by month from now all the way through when we go to 88% capture this time next year. So Justin's got some data on gathering pipeline miles that he'll share with you, but we're rapidly approaching the capacity of what we have out there for infrastructure. So we really need another gas plant or two by 2019 if we're going to meet that 88% capture. So I think it's going to be, particularly in the winter months, we're going to see a struggle month by month to stay above that 85%. And a year from now, we'll really see problems. And what happens in the winter is a lot of water and liquids drop out in the gathering pipelines. It's almost impossible to keep up with what's called a pigging schedule to keep those pipes clear so the gas can move. And so every winter is a struggle, but when you go into winter at or below the capture goals, you are in trouble.
When is it 88% that it's in the gas?
It hits 88% November 1 of 2018. Yes, sir.
Are there gas plants on the drawing board right now or being proposed?
Yeah, the question was, are there gas plants on the drawing board? One Oak still has a potential Eastern McKenzie County gas plant, all designed, but whether that one's probably less probable. Oasis is in the process of permitting and starting construction on a 200 million a day gas plant in Wild Basin. So yes, and then there is some debottlenecking. Kinder Morgan is trying to get a transfer pipeline under the Missouri River so that they can more easily move gas back and forth from the north side to the south side, and that would relieve a major bottleneck there. They have too much infrastructure on the north side of the river and not enough on the south. And so all the force majeure events that we saw were south of the Missouri River this month. I don't know if that's a coincidence. I don't think so. That's where most of the drilling has been happening, and that's where the stress is being put on the system.
What kind of gas plant volumes do we need over the next 2 years to really keep up?
We probably need to be expanding our natural gas processing capacity by 10-12% a year. And ultimately, I think we need to add another, is it 1.5 or 2 BCF? So industry has invested about $13 billion in gas gathering and processing. And our best estimates say they need to invest another 11 billion before gas production peaks. So they're only a little better than halfway there.
There's no more gas questions. Okay.
Are there any consequences to missing that target?
There could be. We're currently working on whether or not any production restrictions are going to be applied. Since it looks like most of it, and I'm going to say that the vast majority, I can't quite give you a percentage, but the vast majority of it is force majeure. We don't restrict production for people that get hit with that. But if we have another bad month, in October, we don't think we will, but then it would certainly result in some production restrictions. So there could be consequences. We haven't calculated those yet. Apologize.
Do you know the volume that was flared?
Yes, I do. Just a second. The volume that was flared was 323 million cubic feet a day. 323. That's a lot of gas. I mean, when I started this job, the state didn't produce that much gas. So that puts in context for you a little bit. And the increase in flared volume was 54 million a day from August to September. So very significant volumes and a real area of concern.
And is it primarily maintenance issues at the plants, or
Um,
the breakdown of those 6?
Yeah, let me just kind of run through those. The biggest one was a maintenance issue with the Garden Creek plants. There were some road restrictions, and there was a natural gas liquids takeaway issue due to some pipeline problems. Then number 2 were the 2 right-of-way delay issues. And then behind that, there was a high pressure pipeline failure that had to, so it required some compressors to be shut down and that pipeline to be repaired. And then there were two compressor stations, one at Garden Creek, one at North Yellowstone, where some big compressors failed. And one of those is still down. The North Yellowstone one is older and it's still waiting on parts. So, but most of it was the maintenance issue with Garden Creek plants and NGL takeaway.
Do you know what caused the high pressure pipeline failure?
I don't.
Okay, switching to pricing, and let me know if you want to defer to Justin on this, but Bakken pricing is trading at a parity with Magellan East, Houston. Do you think that's due to DAPL?
Yeah, my response to that would be yes, I believe so. We have gotten Bakken out of the Cushing, Oklahoma bottleneck and are able to deliver Bakken crude oil to Netherlands, Texas. You saw a contract, 1 million barrels of Bakken crude oil going to China. Hess has been routinely exporting from Netherlands. And so I think all or almost all of that is because of the DAPL pipeline.
Question just about the Bakken in general. You talked about the competition with Anadarko, the Permian Basin. Why is the Bakken so unique compared to those other formations in terms of economics?
I think in general, what you see in the Bakken, and you said in terms of economics.
Yeah.
Right? Okay. So one of the things is I think that the Bakken is further along the technology curve. It was the first shale oil play. And so you're starting to see, it really has remained cutting edge in terms of technology applications as far as fracturing techniques and length of laterals and speed of laterals. But maybe more or equally important is the fact that the Bakken, with the exception of the far northwestern corner of North Dakota, is very overpressured. And so it has a lot of overpressure, much more than most of those other plays. And so the well productivity is quite a bit higher when the rock is so overpressured.
When it was around mid-September when we saw WTI kind of get over that 50 mark, and it's been increasing really ever since until about a week ago. Do you think that's going to lead to increased production in the next 2 months, and does it need to sustain a little further before we start to see it?
Yeah, I think we saw it already in the decrease in the non-completed wells and the inactive well count. So those are both real positives, and that means increasing production. So the answer would be yes, it's high enough now to continue to increase production month over month over month. Unless we get another December storm like we had last year, and then that all bets are off. So we're in a price range now where non-completed wells, inactive wells, even the 50 to 55 drilling rigs that we have operating are all very economic, and those numbers will continuously increase production. I think we could foresee in the not too distant future getting back to that record we had of 1.2 million a day. I think we've got to see that price sustained for another 60 days or so before companies would really add to their capital budgets for 2018, for second half of 18, and add drilling rigs. I think the good news is that it's happening during the time of year when they budget. So that's a real positive. They're actually recalculating their budgets for 2018. So if we see this sustained through the first quarter of 2018, then we should see more rigs and more frac crews second half of 18, first half of 19.
And the U.S., I think I saw reported that the week starting of November 3rd, U.S. hit record production for that week.
Mhm.
As we start to see this like record production in the United States, is that going to cause issues with pricing, and is that production coming out of places like Texas and Oklahoma, or is it happening here as well?
Mm-hmm. Yeah, so the question was about U.S. record production, where it's coming from, and that effect on prices. And it is coming from dominantly the Permian, somewhat the Anadarko in Oklahoma, and a little bit in the Bakken, but our 20,000 barrels a day is not much of that increase. It's really coming dominantly out of the Permian, which has caused, and you'll see it, I think, in Justin's numbers, the prices in Cushing, WTI prices, are well below Brent prices at this point. So that's what's happening there. Yeah, it's affecting the markets. I think what you see in the NYMEX, when you see it going up through the middle of next year and then turning the corner and dropping, is the NYMEX is saying, well, next year OPEC is going to take the gloves off again, and record U.S. production is going to have to discount prices in order to find a home. So that's what you're seeing in the decreasing prices starting in July of 19 and running through June, or July of 18, I'm sorry, running through June of 19. Month after month after month, the price drops. And that's because of record U.S. production.
Okay. The one thing this doesn't do is count for me, so I gotta look at the clock. So we are running up against that 30 minutes. So unless there are any other questions from the room.
Can you remind me what the gas capture target is right now?
Gas capture target right now is 85%, and we missed that by 2. Yeah.
Okay. Okay, we will get Justin on the line.
So you're just gonna watch my iPad and keep up?
I'm gonna share my screen. Okay. Okay, so I'm going to share my screen, folks. So I'm not going to be able to see your questions until after Justin is done. So have at it, sir.
All right. Well, good afternoon, everyone. Justin Kringstad, Director of the North Dakota Pipeline Authority. I'll get right into the standard order of business for these press conferences, and then I've got a little bit of extra material at the end, recapping 2016 construction season for pipeline development in North Dakota. So getting right into the production information, again, holding steady and the rest of the U.S. Williston Basin that we share our transportation network with. Eastern Montana, South Dakota, holding steady. Baker Hughes did report 1 rig active in the Eastern Montana area. South Dakota currently at 0 drilling rigs. This is that new chart, just again, as Lynn alluded to, those month-to-month changes on oil on the top portion of this graphic, and then the gas month-to-month change in the bottom half of this graphic. Again, it's been quite some time since we've seen that growth in the oil and a reduction in the overall gas production for the region. When we look at crude oil transportation out of the region, we did have just a very slight shift moving from August into September. The additional 17,000 roughly barrels of additional production growth from August to September. In my estimates, those were moved by the rail network. So any that incremental oil production was put on the rails, and we'll touch on here in just a couple moments as to what was at play market-wise that helped drive those barrels to the rail as opposed to a pipeline option out of the region. One thing you'll notice on slide 5, again, that dotted line, that follows the right-hand axis. That is the Brent WTI spread. And if you look historically, whenever we see that dotted line start to spike upwards, there has, again, historically been a trend where we've seen the market share shift towards the rail market options as opposed to the pipeline markets. And so as we moved into the third quarter of this year, the Brent WTI spread started to widen. You had coupled on top of that hurricane activity, not only impacting the Gulf, but also some impacts to the East Coast's availability for waterborne shipments to be received at those facilities. And so in the month of September, there were reports of North Dakota crude oil being moved by rail to the East Coast refineries that were not able to access waterborne shipments to feed those refineries. So when we look at the overall trends, again, even with that slight growth, I estimated that the additional production growth was absorbed by the rail network. So again, we're still at historic, relatively low levels compared to where we have been in the past, but we did see that slight increase from August to September on the rail movements out of the region. Where those barrels are headed to, again, this is EIA data. This is lagging a month behind our September report. So again, once the September numbers come, I likely expect that we may see a shift with some additional barrels showing up in that green portion of the PADD 1 refineries. So again, in August, it was dominated by West Coast, but as I just noted, when we move into September next month, we'll likely see a shift with some more market share heading towards the East Coast area. Where prices were at in August, again, PADD 1 having the highest price marketplace for what the refineries were paying on average for their barrels of crude oil, followed up by the West Coast and Gulf Coast. Relatively closer pricing than we've seen in the past. Compared, again, that PADD 2 versus the PADD 3. Again, we've seen that significantly wider spread than what we're seeing here, less than $2 spread. Where we sit today, almost $7, that Brent WTI spread. Again, as Lynn was mentioning, as this domestic production's been increasing, additional storage volumes in that Cushing, Oklahoma area has been depressing the Cushing price relative to the world or that Brent oil price. And until we see some of those barrels continue to move out of that region down towards either the refining centers of the U.S. or being exported out of the region, I would expect this Brent WTI spread to remain at least for the near term. No big shifts in the amount of crude being trucked north and south between the U.S. and Canada. Again, for those that are not familiar with this information, these are barrels that are being trucked either from the Canadian portion of the Williston Basin into North Dakota or from North Dakota to a pipeline system just north of the border. So again, no major changes month to month between August and September. The flaring numbers, again, that increase that we saw, the 3% increase month over month, all was put into that orange basket or gas that's being flared from wells that do have a pipeline connection. And for one reason or another, that system just was not able to handle all of the gas being produced. One major thing, or I should say there are several major things happening in the month of September that supported the reduction in gas capture. There was a number of events on the different pipeline systems where maintenance was being performed, maintenance and turnaround activity at several of the gas plants in the month of September. So I do track the gas activity very, very closely. When we look at the numbers coming into October and now even the first half of November, much stronger throughputs through our facilities. And so again, I don't expect this higher than average flaring from September to trickle into October, November. I do think that the industry has been able to catch up. They've got their maintenance work done, and the gas volumes and the gas plants and the pipeline systems are now back all up and running. And again, just on slide 12, this is that historic look. So we have been trending upwards, and especially the September month, very noticeable, that increase in gas flaring. But again, moving into October and November, so far, things are looking like they will head back to the earlier Q3 type levels. Gas gathering, as far as well connections, those have been keeping pace. The month of September, we did see more gas connections, the new wells being produced. So that was encouraging that the gas companies are getting out and making those connections quicker than the operators are able to bring them online. And then last but not least, on the traditional report, just an update on the natural gas liquids. This is August data. Again, as we see more throughput through the plants, the natural gas liquid volumes in the system that need to be transported to market is going to continue to grow. We'll likely see in the month of September this number go down just because of the reduced volume of gas running through the various plants throughout North Dakota. And now for the special section that I wanted to just provide an update. We're going to take a look at the 2016 pipeline activity miles for the state of North Dakota. Because of the way these numbers are reported, there's a significant delay. We're now in the fourth quarter now of 2017, but we now have availability for the 2016 numbers. And so some interesting developments. What you're looking at on slide 17 in the gray bars, that is yearly additions of pipeline miles within the state. And you will quickly notice from the high levels of the 2012 to 2015 timeframe, a significant reduction in the amount of new pipeline miles in the year 2016. The red line that you're noticing on that graphic is the total miles of gathering and transmission pipelines for North Dakota. So you have an idea there of the total miles moving natural gas, hazardous liquids around North Dakota. And so I wanted to dig a little bit deeper into those numbers to see what was really taking place, where were those miles being put in, what can we learn from that. So slide 18. Okay, so on slide 18, what you're looking at there is just a breakdown. The top portion of this graphic is gathering miles broken out by commodity that's being transported, whether that's produced water, natural gas, or crude oil gathering. The bottom portion of the graphic is transmission miles that were added in the various years. And again, you'll notice pretty equal spread on the gathering between water, crude oil, natural gas. On the transmission side, most of the miles that were added in 2016 were on the hazardous liquids of the petroleum side of the world, as opposed to new gas transmission. One question that I've gotten asked already about this is Dakota Access included in these 2016 miles. My belief is that no. When I look at the PHMSA data, majority of those 2016 miles were what they classified as intrastate transmission and intrastate regulated gathering systems that PHMSA has oversight over, and only 168 miles were interstate hazardous liquid pipeline systems. So because Dakota Access was not operating in 2016, they didn't go into full commercial service until 2017, we'll likely not account for those miles until the 2017 numbers are available. And just for reference, Dakota Access in North Dakota was right around 369 miles of new pipe for North Dakota's transmission systems. And so one question that I wanted to answer was, we saw this large reduction in the amount of miles being added. Is this in line with what we can expect given the activity levels within the region? And so on slide 19 is my attempt to try and answer that. And so the top portion of the graphic, you've already seen, that's just a repeat of the number of new miles per year. And then the bottom portion in red is the number of well completions in the given years, as well as a calculation, which is new miles of pipe per well completion, which is one metric that the industry just uses generically as kind of a guideline for development in the region. And so you'll notice the gray line, that's the miles of pipe per well completion. Historically been hovering between that 1 and 2 range, and even into 2016, because we had such a reduction in the number of completions, was still within what I would consider a normal range of about 1.25 new miles of pipe per well completion. So that was interesting to know that we weren't completely askew with the amount of miles being built. And then the second thing I wanted to look at on slide 20 was how much of a footprint is the pipeline industry having to develop. And so I just took snapshots year by year of the various development patterns that we've seen in North Dakota, and I calculated the number of square miles impacted in those given years. And so right in the center of slide 20, you'll notice 2012 was our highest level of activity. Over 16,000 square miles were being impacted by oil development in western North Dakota, as compared to, we'll just compare it to 2017 year to date, we're at about 3,500 miles of area being impacted. And so that has an impact on the amount of miles necessary. And so slide 21, just for further analysis on my part, I wanted to compare new miles of pipe relative to how many square miles are being impacted. And again, things were trending very closely between, again, how much spatial distances the pipeline systems were having to develop with the amount of miles being put in for the various years. And then lastly, slide 23, what I want to touch on is crude oil gathering, that comparison of truck versus pipe. This has been updated now through with some 2017 data. You'll notice at the top portion on slide 23, that is the estimated pipeline gathering volumes for the state. And then the bottom portion is the amount of trucked volumes for North Dakota. The crude oil gathering by pipe has held fairly steady, extremely steady, surprisingly steady, to be honest, from year to year between 2015 and 2017. Again, most of the new miles are just reaching out and connecting new development. We have not seen in 2016 and 17 any major new gathering systems. Most of the gathering work is just getting connections and helping to fill natural decline on some of the existing facilities. And so one thing going forward in the near term, at least, until we get some new larger scale gathering systems put into place, any incremental growth in oil development and production in North Dakota is likely to be met by trucking volumes for the near term until the industry is able to get some of these larger scale systems built, as we've seen in the past. And then slide 24, last but not least, this is just again for full details. This is a comparison county by county of how they're doing with piped volumes on the top, truck volumes on the bottom. Again, if we just look at McKenzie County, for example, that's one county that's had a lot of success getting new crude oil gathering built by pipeline. So you'll see their volumes continue to grow. And then 2016, 2017, the amount of crude oil trucking has been going down in that county. So again, just for full disclosure, you're able to look at all the various counties. So with that, I'd be glad to answer any questions about the first portion or the second portion of the material.
That is why he is the data analysis dude. Okay, can you explain a little bit more why crude moved by rail to the East Coast?
Well, what was taking place in the month of September?
Yeah.
Yeah, so there was a few things going on. So the industry was still trying to figure out and work its way through the Gulf Coast impacts from the hurricane season, as well as it was Hurricane Maria that was impacting deliveries to the East Coast. So the PADD 1 refineries that historically have been geared, so they're fully capable of handling Bakken crude coming in by rail car. They had shifted away from it to taking more waterborne barrels because of market conditions. But again, those waterborne shipments were not able to be delivered as expected. And so as a solution, there were trains leaving North Dakota headed to the East Coast to feed those refineries during that time.
Do you anticipate any major liquid pipelines being built in the next 3 to 5 years?
Right now, nothing's been publicly announced as far as a major new crude oil line or a major new natural gas liquids line. But the industry has definitely got their eye on the ball, trying to figure out, again, what is the appropriate timing, what is the appropriate scope, scale, size, destination, all those things. Right now, the industry is very active trying to figure out the timing for the next project. So we're definitely not done with the need for new pipelines in North Dakota. Now it's just the appropriate timing and scope.
What is the average life of a pipeline?
So the average life of a pipeline, that's a real difficult question to answer because of the way that pipelines are maintained and operated. It's similar to the question of how long a vehicle can last. It really depends on who's driving it, what type of maintenance programs they have in place. It's very typical for a pipeline when they do their inline inspection, the pigging operations where they can send a smart pig through the line. if they notice any type of defect or concern along that line, they will simply cut out, replace, or repair that segment of pipe. They'll replace pump equipment as necessary. So again, the same pipeline that may appear to be 50 years old, but much of that equipment has either been maintained, replaced, updated. So that's a very difficult question to answer.
Okay, I think everybody's trying to let stuff sink in, so I'm
Okay.
sure we'll see some follow-up questions in the coming days. So thanks for that, and thanks everybody for jumping on the call. And with that, we will end this meeting.
Yep. Thank you.